I want to take you through some advanced case studies right now. These are the kind of things we tend to get into in pro, but I'm going to start to expose you to them here in a case study form so that you start to see, again, how some of these purchases come together and are incredible in the way that value is produced and the way entrepreneurial spirit and entrepreneurial innovation and entrepreneurial know-how can take the rudiments of a business and put them together in a unique way that makes them viable, financeable, and profitable. So here we go. The first case study I'm going to cover with you deals with barter, trading what you've got for what you want, and trading what you want and don't even have yet for other stuff that you need or want, okay? And we're going to start here with two disgruntled cruise line employees, okay? So here you got two employees who work for this big cruise line. They knew the cruise business because they'd been in it for 7 to 10 years each, but they really were fed up with the company they worked for. What these guys did is they went out and got control of a rusted secondhand liner, okay? It was operable, machinery and equipment was all pretty decent in it, but didn't look too pretty. And they were able to get control of that. It needed this extensive paint job really bad. They bartered paint for future bookings on the ship. Now, the ship that they had now control over had 500 unfilled rooms in it, worth $1,000 a week if they're used. Virtually all are unsold because the ship wasn't operating, right? Because there's all these unsold rooms, all right? There's $500,000 worth of buying power per week sitting in these rooms if they can get the ship shape and get it advertised and get bookings and all that stuff, right? So there's $500,000 a week that they can get their hands into, but they got to get the ship up and running in order to do that. So they bartered for advertising with radio and TV stations, magazines, in exchange for future bookings a year later. So they get the advertising time now, and the media and the stations, the magazines, they got the rights to fill these rooms on a cruise that'll happen a year from now. So meantime, they got advertising that they can use right now. Through the advertising, they brought in deposits, right? Because then you're going to go on a cruise and you like the idea, they sell you the idea of a cruise. Okay, so you put up money, right? You put up a deposit. Well, the deposits were enough to complete the painting, repairs, and the upgrades that they needed to get the ship seaworthy and ready for sailing. But all of this was now getting taken care of from the deposits from the advertising that they had. Then the payments, of course, get collected prior to the cruise. So prior to the cruise, they have all the money to pay for the provisioning of the ship with food, fuel, etc., the crew and the entertainer compensation, and everything else was actually plenty of cash left over, all paid for out of the fact that they had this advertising that brought in the business. They parlayed this barter model into a second and third newer liner, and then they eventually sold it to a major international cruise line for over $100 million. So that is the power of entrepreneurial thinking. It's looking at the assets that are out there. How can you leverage them into doing what you need to do? Who can you trade what with to give up something that you either don't need or that you can give them at a deferred time, when if you have the thing you're trading for first, that lets you get your thing up and going and making money, so that when you have to deliver what you traded, it's an easy for you to fulfill your obligations under the trade. Let me give you a second case study here. This is a publisher takeover and turnaround. And this one here is based on assuming debt, licensing out IP, intellectual property, and creating revenue from licensing, and barter. So these are the three elements that are going to come together here. This has to do with a publisher that was losing money. It had over 600,000 subscribers, and it also had a fulfillment obligation that it could not pay for. So in other words, the company was not well managed, they were out of money, they had more issues that they were obligated to deliver, but the advertising revenue was not enough to cover those fulfillment costs. Nobody could put more money into the company, so it was a fire sale. They had to get rid of this company. They didn't know what to do with it. They weren't running it well, and that's what was going on for them. The buyer gets control by agreeing to assume the fulfillment liability. So the buyer isn't putting up any money. They're just agreeing, look, I'll take over the obligation to deliver out the publications, and in exchange for me doing that, you're going to give me control of the company. So the old owner maintained a minority interest. The major interest now goes to the new buyer, and they don't put up a dime, but they're obligated to cover the future distribution requirements of getting the magazine distributed. All right, so hopefully you got that picture. So what they did is they did an early renewal campaign where they took all the subscribers, all 600,000 of them, and they offered them the ability to renew immediately, even though their renewal wasn't due for another 6 months or even a year, but to do it at a discount. And the discount was substantial enough that a very high percentage of them renewed early. It brought in $4 million, $2 million more than was needed. They licensed out the magazine's library of art and geographical photos. That generated another 7 figures per year in licensing revenues. One of its magazines, because it was the publisher owned several different magazines, one of its magazines was a hard sell at $10,000 a page, but they realized it was an easy trade. Okay, what that meant was they could trade advertising on those pages at $10,000 per page for airfare, luxury hotel rooms, big screen TVs. So basically they got this stuff in exchange for giving people the right to have their $10,000 page and advertise on it. So they got stuff. They then sold the stuff at 50 cents on the dollar. Because remember, they're all about generating cash right now. So they converted a $1,000 page cost, because now they got to print the ad on that page. In many cases, it's adding a page every time they sell it to the magazine, and it costs them $1,000 a page to add the page and print it and put it into publication. Okay, but they turned that into a $5,000 per page income. Why $5,000 per page? Because it was a $10,000 page that they traded for, but they sold what they traded for at 50 cents on the dollar. So the bottom line is they took something that would cost them out of pocket $1,000 and turned it into $5,000 every time that this publication published its issues. Then they actually did something else with their magazine. Okay, now remember, he owns the magazine, he controls the magazine. The old owner couldn't figure out how to make it profitable. He has money coming out his ears now, but he comes up with another idea for trading and bartering. His company went out and bought a manufacturer of a single great product, but that product had virtually no sales. It was just barely selling anything. But it was a great product. Everybody knew it was a great product, but they didn't have marketing money. Okay, so he buys this thing, and the purchase is made 100% on deferred payments. In other words, the old owner was just frustrated, didn't know what to do with it. So they agreed upon a valuation, which was low because it wasn't making money. And the seller took back a note for the vast majority of the purchase because he couldn't do anything with this company. And he'd rather have this guy own money that hopefully he's going to pay than own his company that's going to continue to virtually lose money. So the purchase was made on deferred payments, and he used unsold pages in his magazines to advertise the product that was this great product, generating sales and distribution. So this not well-selling product, this company losing money because it doesn't have sales, all of a sudden goes very quickly from a company that has those issues to a company that has substantial sales and is making a substantial profit. He didn't want to be in the manufacturing business. This was a money play for him. So he basically flipped the company and sold it to a big company, literally for millions in profit, because he took a company that had low value because it's not making any money. Through his advertising capabilities, he brought the company to where it's now making substantial amounts of profit and has sales, to where it now has substantial value, and he now sells it for that value to the big company, and the big company, of course, has the cash and the wherewithal to pay him cash. So anyway, you get the picture, okay? This is the kind of thinking that goes into it. Remember, he's not a manufacturer, didn't want to own this company, didn't want to run this company, but he knew he had advertising capabilities that could turn this company into a great company with great sales by just leveraging his advertising capabilities to do that. Next case study, software company, joint venture. This is what we call a build-up buy-in. I may have a little difficulty explaining this to you because it's a little complex. We don't have that much time, but I'll do my best. All right, software company, existing software company, sold expensive, high-priced software that only converted a small percentage of its leads to sales. So in other words, you got this company, they've got this Cadillac, maybe even a Rolls-Royce type software product. They spend money to market it. The marketing brings in hundreds and hundreds of leads, but only a handful of leads really are going to be converted into sales because of the high-priced nature of this particular software that they're selling, okay? So that's the picture. Now, a marketer for them realized that the company was a lead machine for a lower-priced software solution. In other words, they got all these leads, they're throwing them away. So he realizes that there's lower priced versions of this that are nowhere near the quality of this, but would probably suit a lot of the leads that they're not able to convert. So he went out and found a software company with a product in the low end of the market. The marketer offered to do a joint venture with the expensive software company to use its non-buyer leads to do a build-up buy-in with the low-priced product company. Before I get to that, I might need to explain to you a little bit more about a build-up buy-in. Okay, what a build-up buy-in is, let's say I own a company, okay? And I make a certain amount of money, the company's worth a certain amount. I want to sell it at some point. I want to get the highest possible price for it. And the price I want is maybe even higher in my expectation than the company's worth. Whatever the reason is, I own a company, it's doing X and it's worth a certain amount of money. So somebody comes along and offers to do a build-up buy-in with me. And what that is, in this case, would come to me and say, look, I can increase your sales by 200%, okay? I can do that. And what I want to do is I want to come here and do that for you. And you don't have to pay me anything more than a normal commission to do that. So when I make the sale, you can take some of the money from the sale and pay me my commission. But if I do that for you, I'm going to make your business twice as valuable, 3 times as valuable, 5 times as valuable as it is now. So I'm not going to just do this for a commission. I'm going to do it if you'll agree to a build-up buy-in. And what a build-up buy-in is that we'll set milestones. And the milestones are right now you do, and I'm going to make these numbers up, 10 million in sales. And you've spent years growing at 7 to 10% per year in sales. I'm going to take your company not to 11 million by the end of the year. I'm going to take it to 1 million by the end of the year. And when I get to 13 million, I'll have been paid commissions. But when I hit 13 million, that milestone, I've earned an ownership share in the business of 10%. Now, you just made the company worth 30% more than it was before. So if the seller now grants you back a 10% owner, he owns 90% of a company that is 30% more valuable than the company was if you hadn't done this. So it's almost a no-brainer. He doesn't pay for anything he doesn't get. He pays you your commissions out of the cash flow of the business that you create, and he gives you an ownership that's only a piece of the value of what you've added to his company. So that's your first milestone, 1.3 million. Okay. The next milestone might be 15 million of sales. Okay. And then you get another 10%. And the next milestone might be 20 million in sales. And that's where you get your next milestone, you get another 10% ownership in the company. The point is, every time you hit a milestone, you get equity in the company. And every time you're getting that equity in the company, the owner's percentage of ownership goes down. They're still in control, right? They still own more than 50%. They still control it, but their ownership percentage went down, but the value of the remaining percentage they have is always going up and going up substantially. So that's the deal that this marketer made with the low price software company. Okay. So joint venture eventually earned, remember, he did this in conjunction with the owners of the high price software, where they're working together now in a joint venture to do this build up buy-in. So the joint venture, which is the marketer and the owners of the high priced software, that JV, that joint venture, earned a 40% stake in the low price software company within 18 months. In other words, those leads were so valuable that the marketer was able to turn that into sales in the low end company at such a rate that within 18 months, they earned through that process a 40% stake in the lower price company. The marketer then sold to the high price software company his share of the JV for 2.7 million in cash and stock in the high price software. So he gets cash and he's now an owner in the high price company. Then the high price software company bought the balance of the low price company for shares and deferred payments that could be made from the low price company's cash flow. Okay, so you see how all of this works now, right? Okay, it's just a matter of know-how. You got to know what you're going to angle for. You got to know what you're trying to accomplish. But the tools are all here. So the marketer ends up as the head of marketing for the combined company and a major shareholder in that combined company, looking forward to an IPO where he and his joint venture partners here are going to come out incredibly well, because they're going to take a company that is a private company that was worth 7 or 8 times earnings and convert it into a public company that's worth at least 12 to 18 times earnings. So the minute that this thing goes IPO, they blow up the value of all of this thing that they just created, and they've got an incredible software company that is ripe for a public offering. Okay, so hopefully you got a sense of the thinking processes that go in here. Now, if you weren't exposed to bizarre financing, I'll guarantee you would never ever think of anything like this. Stuff would be like Greek entirely to you. And it's the reason why people who aren't exposed to bizarre financing don't see the same opportunities that people who have been exposed here see. It's a different world once you realize that these types of thinking, this type of technique, this type of process exists, and it's only restricted literally by your ingenuity, your imagination, and your knowledge. Next case study. It's called a SPARC, and SPARC stands for simultaneous purchasing and raising investor capital. And it means from this business you want to buy, the same company that you would go to purchase your primary products that you're going to resell is the same company that is likely to want to invest in your business if you present it correctly. Okay, so that's the story here. So the tire store retread, that's our name for it. In this case, 2 ambitious employees of a tire manufacturer see a small chain of tire stores that are for sale. They work for the manufacturer. They're managers, one's a sales rep, and they see a small chain of tire stores that are for sale. The chain is located in a region underserved by stores carrying this manufacturer's brand. So in this particular region where this small chain is, the manufacturer has no representation of any tire store in that region selling their tires. The chain, of course, does not carry the manufacturer's brand. So what the employees now do is they will buy the chain and convert it to selling the manufacturer's brand. Okay, now you can see why the manufacturer would love this idea, because now they got distribution into an area that they don't have distribution if these guys can buy that company. So the employees present the tire company with a plan to support their purchase of the chain. The tire manufacturer is asked to loan the employees an amount of money equal to the value of the existing inventory. So what are they going to secure the loan with? The inventory. So the manufacturer, so far, they've got cash. They're not going to take much risk here because their loan is going to be secured by the inventory of the existing chain. And they're going to have the ability to now have that chain sell their tire. All right. The tire manufacturer agrees to loan the employees the amount equal to the wholesale value of the existing chain's inventory. And of course, they take a lien against it. It's a little difficult, but they take a lien against it. And the employees now buy the chain using the manufacturer's loan on inventory, an asset-based lender loan on the equipment. You guys all know what that is, right? You all know what it is because you know how I bought my first company and how I got asset-based lenders to make the loan, double escrow, all that stuff, right? All right, so they got an asset-based loan on the equipment. Then they had seller financing payable over 5 years. Between those 3 resources, they were able to come up with the purchase price. The employees then liquidate existing tire inventory. Okay, now they take over, right? So they liquidate the existing tire inventory at a 20% loss to other dealers to pay back the manufacturer. Okay, now why do they do this? Well, they do it because the whole idea is they're going to become a specialty store for the manufacturer, which is why the manufacturer is so anxious to help them with this transaction. And who are they going to sell the inventory to? There are plenty of dealers in this area that if those dealers can buy the inventory at 20% below wholesale, they'll take it all off their hands tomorrow. They'll all back their trucks right up to their facilities here and have certified checks in their hand to be able to get that inventory at that level of discount, because that's all that much more money they make when they sell it. Getting the inventory sold to make room for the new inventory of the manufacturer's tires is now accomplished, and most of the loan is paid back to the manufacturer. The manufacturer ships the new inventory of its brand to the chain on extended terms, okay? Remember, we got a friendly manufacturer here, wants to help this purchase happen, so he gives these guys nice extended terms when they ship them the new inventory. And the manufacturer prices its new inventory to the chain at a deep discount for this first go-around to offset the 20% loss on the sale of the old inventory. The employees who bought the chain come out whole. All the money is being fronted to them for the entire thing. They've got their inventory of new tires to sell for the new manufacturer. The new manufacturer is as happy as a clam because they now have distribution in an area they didn't have it in before. And they're not out of pocket a dime for all this when everything washes through. They're fully covered. And they just start making money now as the sales start coming in from the chain in the area that formerly didn't have anyone in that area carrying their tires. So the manufacturer gets a no-cost expansion of its distribution. The new owners are fully funded for the purchase of the chain. And that's the way it was done, okay? Incredible. And that's the way entrepreneurial thinking works, and that's the way bizarre financing techniques get used. Okay, publisher consolidation using crowdfunding and roll-up. Now, you've heard of crowdfunding. I'm not going to get into a big explanation of how crowdfunding is done here. We do in Pro because we want to make a usable technique for everybody. But crowdfunding is a wonderful technique, a wonderful way to take things that you can give away to people and you get them to send you money over the internet. And in this case, this publisher has stuff that they can give away because they can give away subscriptions and contests and all kinds of things that they can do with all the publications they're going to own once the deal is done. So our BF grad happened to notice, they were from the publishing field, they happened to notice that there was a fragmented marketplace in these publishers. There were many small publications that were losing money or marginally profitable due to high infrastructure costs relative to sales. By infrastructure costs, it means in order to have a magazine, you got to have writers, you got to have editors, you got to have an office, you got to have salespeople, you got to have, right? All this stuff costs money. And if your one little publication that you own isn't bringing in enough money, then you can't pay for that infrastructure cost. That is what this individual noticed that the industry was full of, was those little tiny companies that had nice little publications, but their infrastructure cost was killing them. They realized that these companies could be bought at a bargain and with small down payment and deferred payments over time. They did have a problem, however, and the problem is the buyer didn't have the small down payments to make. The buyer also had a problem because the publisher that they now would own would still be losing money after the purchase or not making enough profit to cover the deferred payments. So yeah, they could pull it off, but now the company isn't making enough money to pay for itself. And the next problem was the BF grad tried to buy the publishing company, but once the lenders realized these things couldn't pay for themselves, he couldn't raise the money. So traditional financing totally crapped out, pardon my language. Your BF grad then crowdfunded enough cash for the down payment on 2 publishers, picking up more subscribers in the process. Because what did he do? They gave away subscriptions to the people who sent money in onto the crowdfunding project. So now they got more subscribers. Now they didn't get any more money. They got the money coming into the crowdfunding, and then that was used for the money he needed for the purchases. But it didn't help money for the cash flow because the money was used to buy the companies, not for cash flow once they're owned. So the subscriptions are out there, but what the subscriptions do is your advertising rates are based on your subscriptions. So the advertising rates are now higher because there's way more subscribers who got their subscriptions through the crowdfunding resource. And so the advertising values went up. And so now the companies would have more cash flow because of the higher advertising revenues. And because they bought 2, he consolidated their operations, eliminating one's infrastructure costs. The consolidated publishers began operating now profitably. Higher advertising rates, lower infrastructure costs, means they're making more money. Additional crowdfunding then was used for down payments on another publisher. The third publisher's infrastructure was eliminated, creating more profit and surplus cash flow. And then the grad continued to roll up these small publishing companies using its surplus cash flow instead of more crowdfunding to cover the down payments. Okay, so that's how that was done. And the technique takes crowdfunding and then a roll up, and this can be done in many businesses. Now, I know we're running out of time. In fact, we're past the time limit here, but let me put a nice bow on this for you. What do these case studies all have in common? Okay, cruise line, disgruntled employees. One publishing company that was a publishing executive did that. The software company, a software marketer, did that. The chain of tire stores, employees of a manufacturer of tires did that. Another publishing group, but it was a publishing employee who did that. So one of the things they all have in common is the proximity to the business of the buyer. Okay, in other words, these people were no different than all the other employees and everybody else that knew or was involved with any of these fields or any of these companies, but the thing that they did have was proximity. But a lot of other people had that proximity too. And the other people who had the proximity didn't see the opportunity and certainly didn't know how to cash in on it or take advantage of it, and in fact never ever saw it even as an opportunity. So proximity to the business is a key element that helped all of these people, but it wasn't enough. It wasn't enough. Bizarre financing is what opened their eyes to the opportunities. That's the training that they had here is what enabled them to open their eyes to now see things as opportunities that no one else was seeing. No one else knew, even had an inkling how to put them together. Bazaar Financing gave them the tools and the know-how to seize the opportunity. That's the keys, folks. The ability to see the opportunities that are around you and have access to the tools and the know-how to seize those opportunities and make them yours. And so the question I'd like you to simply ask yourself, what business do you know well? And are you in the proximity where being close to that business, you can see those things now that nobody else sees because they come up all the time. They're not flukes. This is just all part of life. They're going on all the time. What's your passion? Your passion puts you in the proximity of whatever you're passionate about. And that's where you'll start to see all of your opportunities bloom. All right. So there are elements that once they come together, position you for your future wealth creation. And I've just tried to review them with you so that you have a better understanding of what they are and how they work.